In this lecture, we're going to learn about one of those modern conveniences that we rely on so much that it's hard to imagine life without it. You know, like our mobile phones or computers. Or how about our cars? Sure, we could get by without them, well, maybe for a few days at least, but it would be really inconvenient, if not downright painful. In this lecture, we're going to learn about a modern convenience that's even more important than either cars or mobile phones. Banks. Yes, banks. You may not give your bank or what it does a second thought, but in fact, banks are one of the most important parts of the financial markets. In fact, for most countries, banks virtually are the financial markets. Banks do so much for us that it's almost impossible to imagine life without them. Banks are what we call financial intermediaries, literally middlemen who stand between borrowers and lenders and help money go back and forth between the two. Now, that might not sound important. In fact, it might even sound like banks aren't really necessary. But banks aren't simply passing the money from lenders to borrowers and back. They need to put in some serious effort to get money to flow from lenders to borrowers and then to flow safely back to the lenders again. Remember that we learned in an earlier lecture, the health of the financial system depends on our ability to keep the money moving through it. A big reason why banks are so important is that they're better than just about any other organization at getting the money to flow between lenders and borrowers. The business of banking starts with taking deposits. In most countries, the definition of a bank centers on this activity. In the US, for example, a bank is legally defined as a business that takes deposits and makes loans. A bank deposit is, as its name suggests, a way for a person to store value by placing or depositing it in a bank. In the simplest deposit contract, the bank promises to keep the money safe and to return the money to the depositor whenever the depositor wishes. So at the most basic, the bank is like a public vault that anyone can use to store items of value for a fee. The story that's often told about banks is that they're an offshoot of the goldsmithing or jewelry business. These professions worked with gold, so they needed to have very strong safes or vaults to prevent their gold and the finished products they made with gold from being stolen. Many households also had gold and other valuable items that they wanted to protect as well. But vaults are very expensive, so most households couldn't afford to buy them. They noticed, though, that goldsmiths had these vaults, and naturally they asked whether they could use the goldsmith's vault to store their gold and valuables also. Goldsmiths realized that they could earn fees for safekeeping other people's valuables, and so the local goldsmith became the place where families would store their savings or other valuable items. We still have this tradition in place, by the way. Most banks will rent out a safe deposit box to you, where you can store documents and other small valuables inside the bank's vault. From that beginning, it wasn't too long before people realized that if you and all your neighbors held their savings in the goldsmith's vault, then it became really convenient to pay your neighbor anything you owed them in the following way. Just write a note to the goldsmith instructing him to transfer some of the gold that was in your box in the safe to your neighbor's box. Or, if you owed money to someone, you could write a note that instructed the goldsmith to remove some of the gold from your box in the safe and give it to the person who presented the note. These payment instructions, of course, are checks. So the goldsmiths didn't just hold gold and other valuables on behalf of their customers, they began to make payments on behalf of their customers. Imagine how convenient this was for the person who held their gold coins in the goldsmith's vault. They didn't have to carry heavy, bulky gold coins around, and they didn't have to worry about being robbed. If you wanted to pay someone, you didn't have to wait around for the goldsmith to be in his shop. All you had to do was write a note of instruction to the goldsmith and hand it to the person you were trying to pay. It was their problem to collect the gold from the goldsmith. Even after gold coins were replaced by paper money, people continued to pay for purchases, especially big purchases, by issuing payment instructions like checks rather than by using cash. It's so much more secure and convenient to have the bank hold your money and make the payments for you. And of course, if you can ask your bank to make your payments for you, you can also ask your bank to collect payments from the people who have given you checks drawn on their banks. If I receive a check as a payment, I present it to my bank, and my bank would then go to the other bank and present the check for payment. The business of making payments transferring money and other valuable items back and forth between people, is incredibly important to every economy. In fact, this job is important enough to be added to the list of financial functions that we've been learning about in this course. The formal name of this fifth function is clearing and settling payments. As this phrase suggests, there are two parts to making payments. The first part, clearing, is about making sure the payment instruction gets to the right person or business. For example, if I pay my credit card bill by sending a check to the company's payment processing center in Delaware, then the credit card company has to find some way to present that check to my bank, which is located several states away. Once the check comes to my bank, the bank verifies that this is an authentic payment instruction. If the bank agrees that the check really did come from me, and I have enough funds in my checking account to cover the amount of the check, then the bank will proceed to the next phase of the payment process, settlement. In settlement, the money is actually moved from my bank to the credit card company. Once the money reaches the credit card company, the settlement is declared final, meaning that neither I nor my bank can change our minds about actually making the payment. Up to the time that settlement is final, I could technically stop the payment by giving my bank an instruction to do that. Needless to say, in the old days, clearing and settlement was a huge hassle. Companies and banks had to physically deliver payment instructions like checks to the banks they were drawn against. And then they had to take the money back to their own banks, which again was costly and dangerous. These expenses made people reluctant to accept payments from banks that were far away. In addition, people tried to cheat each other by presenting fake checks drawn on banks that didn't even exist. So this made people even more reluctant to accept payments from banks that were in another city. To overcome these problems, banks in large towns started to meet regularly to pass payment instructions from each other's depositors and money back and forth. And in the big cities, the banks had to meet daily to make these exchanges. The banks would all chip in to rent or buy a building where they could meet and make these exchanges daily. And these places became known as clearinghouses. Clearinghouses are important because they're the basic model for how our entire payment system works today. When global banks like HSBC and Citibank make billions of dollars worth of payments to each other, they use an arrangement that's based on the basic clearinghouse model, with some updates, of course. Here's a quick example to show you what goes on in a clearinghouse arrangement. Let's consider two banks. Call them Annie's Bank and Bob's Bank. On Monday, suppose that depositors at Annie's Bank buy a total of $1,000 worth of goods, services, and assets from people who bank at Bob's Bank, and they pay by check. So these customers of Bob's Bank deposit these checks in Bob's Bank on Tuesday. Also, suppose that the depositors at Bob's Bank buy a total of $2,000 worth of goods, services, and assets from people who have their accounts at Annie's Bank, and they also pay by check. The customers of Annie's Bank deposit these checks in their bank on Tuesday also. So at the end of Tuesday, Annie's Bank is holding $2,000 worth of checks drawn on checking accounts at Bob's Bank. And Bob's Bank is holding $1,000 worth of checks drawn on checking accounts at Annie's Bank. So on Wednesday, Annie's Bank and Bob's Bank meet at the clearinghouse. They present the piles of checks to each other, and each bank verifies that the checks are authentic. So the checks are cleared. Next, they're settled using a process called netting. Notice that Bob's Bank owes a total of $2,000 to Annie's Bank. Annie's Bank owes a total of $1,000 to Bob's Bank. In netting, we net out the total amounts owed by subtracting the smaller amount from the bigger amount. And then the bank that owes the larger amount pays only the difference between the two. So Bob's Bank owes Annie's Bank $2,000 minus $1,000, which of course is $1,000. So Bob's Bank gives Annie's Bank the $1,000, and then the payments are declared final, and they've been settled. These days, whenever you use a payment using some kind of payment instruction rather than cash, your payment is cleared through some kind of a clearinghouse. There are private clearinghouses, and one of the largest ones is operated by the Federal Reserve. Now you may notice that I just used the term payment instruction rather than the term check. That's because over the years, information technology has made the process of clearing and settlements faster, safer, and more convenient. Now, in addition to using paper checks, many businesses and organizations accept electronic funds transfers, EFTs for short. These transfers can be as simple as using a debit card at the grocery store, or you may use your computer to make a payment from your checking account. These are all EFTs, electronic funds transfers. Even when you write a paper check these days, it's often truncated. That is, an electronic image of the check, like a digital scan, is made and the paper check is actually destroyed. The digital image is passed on to the bank and the clearing and settlement process proceeds as usual. I've talked about the payment system for quite a while, not only because its history and development is interesting, but also because it's so important to our modern economy. Because we have the ability to clear and settle payments quickly, easily, and safely, we can buy and sell things literally all over the world. The modern payment system supports economic growth by connecting more potential producers with more potential consumers. The payment system is a lot like the plumbing in your house. When it works, you hardly notice it, but when it breaks, life is miserable. Payment system failures or disruptions are how problems in the financial markets typically spread into the rest of the economy. If a big bank fails, for example, then this means that payments from the bank's customers can't be cleared and settled. This may have a domino effect on other banks, so that all of a sudden, millions of people can't get their payments cleared and settled. When you can't pay for anything, you can't buy anything, because everyone expects to get paid for the work they do or the products they sell. So when payments can't be made, companies shut down because they literally don't have the ability to pay their workers or their suppliers. Companies like General Motors, for example, need to have billions of dollars of money in the bank all the time just so they can make their day-to-day payments. A payment system failure often leads to long and painful recessions. The Great Depression, for example, was so bad in part because of the failure of a large part of the payment system. And the reason why the financial crisis in 2008 led to a recession was that it was caused by big problems in the payment system that hadn't been seen since the Great Depression. The final thing I want to mention about banks and payments before we go on is that clearing and settling payments takes effort and resources. It costs money to move money from one person to another. When a bank makes and collects payments for you, it has to put a lot of resources into this activity. And this helps explain why banks often charge significant fees on their checking accounts. But if you think that fees on your checking account are high, consider the alternative, living without a bank checking account. Not only do you have to figure out some way to store your cash safely, you also face the expense of making and collecting payments in cash. If you can't make your payment in cash, then you have to buy something to make the payment with. One example is a money order, which is a check that is issued in the name of a company rather than an individual. The fees for money orders run between about 50 cents and well over $1 per money order, depending on the company selling it. You could also use prepaid debit cards to make payments. These also carry fees, such as fees to load the card with money and monthly fees for keeping the debit card active. Collecting payments from other people is also expensive. Although some stores will cash checks issued by well-known companies or banks if you make a significant purchase there, generally you'll have to use a specialized business called a check cashing outlet. These businesses charge fees based on the amount of the check cashed and the riskiness of the person or the company who wrote the check. Living without a checking account can get quite expensive. Nonetheless, in most countries, at least some people live without using a bank account, and in many countries, a significant part of the population doesn't have bank accounts. Even in the US, for example, different studies estimate that the fraction of the adult population that is unbanked or doesn't have a bank account is between 8 and 12%. So up to an eighth of the adults in the US use these alternative payment methods as their main means of making payments. For many of us, though, not only do we have checking accounts, but we also have so-called free checking. We don't have to pay a fee for a checking account in the bank, and we use as many payment services as we want. How can that work? Well, if you have a so-called free checking account, you're still paying for it, though not through upfront fees. To see how you're paying for your free checking, we need to look at what banks do with your deposits other than making payments for you. That, of course, is making loans. If we go back to the goldsmith and his vault, the story is that the goldsmith noticed that most of the people who stored gold in his vault just left it sitting there for long periods of time. A few people did come by to take their money out of the vault, but they didn't do it often. And when they did, they tended to take out only a little bit of it, not all their coins. At the same time, the goldsmith noticed that there were plenty of people in the town who would gladly borrow some gold to build a house or start a business, and they were willing to pay a healthy rate of interest on these loans. Well, if the money is just sitting there, thinks the goldsmith, why don't I lend it out? If the loan is paid back in full and on time, then I keep the interest and the depositor has all his gold back. If the loan isn't paid back, I'll just have to take some of my own gold and replace the gold I borrowed from the depositor. Well, you can imagine that this opportunity was just too good for most goldsmiths to resist, and so-called fractional reserve banking was born. We call it the fractional reserve banking system because the money the bank has on hand to pay back depositors, that is, the reserves, are only a fraction of the deposits. Most of the deposits are loaned out at any given time. The lender is trying to lend successfully so he can keep the interest on the loan as his profit. But some of the deposits are always on hand so that when people come back to take some or all of their deposits out, the bank has enough cash to meet this demand for withdrawals. Now we can see how banks make their living. Providing payment services is important, but it's not really a big source of profits for banks. The real profits are in borrowing money from the depositors and lending the money out to households and businesses. Again, that's why we say that banks are financial intermediaries. They stand between the ultimate borrowers and the lenders. Banks borrow from their depositors in two main types of accounts: demand deposits and time deposits. A demand deposit, as its name suggests, is a deposit that may be withdrawn at any time, that is, on demand. One type of demand deposit is a checking account, which is also often called a current account. These demand deposits may not only be withdrawn at any time, but they may also be used to make payments through checks or EFTs. There are other simple demand deposits without the ability to make payments, and most of us know these as savings accounts. A time deposit, as its name suggests, is a deposit contract in which the depositor explicitly agrees to leave the deposit in the bank for a minimum amount of time, say 6 months or 2 years. Needless to say, these accounts can't be used to make payments. It's possible, however, for someone to withdraw their time deposit before the time is up. But if you do, the bank will reduce the amount of interest you get dramatically. In some cases, it will actually give you back less money than you deposited. This is the so-called penalty for early withdrawal. How can the banks do that? Well, it's simple. If you make a time deposit, you sign a contract giving the bank the right to do that if you have to withdraw the funds early. Why the banks do this is also important. Banks like to issue time deposits because it means that they can count on the depositors to leave the money in the bank so that they can lend the money out for the full time of that deposit. If a lot of the depositors sign up for time deposits and then withdraw early, this could potentially leave the bank without enough money on hand to cover the normal withdrawals from the demand deposits. So they build pretty strong penalties into the contracts to give borrowers the incentive to keep their promise to leave the money in for the entire period specified in the contract. The bank pays interest on all these different deposits, of course. Generally, the longer the bank can count on you to leave your deposit in the bank, the higher the interest the account pays. In the case of current accounts, the interest is often paid in kind instead of in cash. That is, if you have a so-called free checking account, then the bank is paying you interest in the form of payment services. But since payment services are fairly expensive, banks usually require depositors to hold a minimum amount in their checking accounts at all times in order to earn free checking. On the other side, the bank earns interest on the loans that it makes. There are all kinds of ways to slice and dice the types of loans that banks make, so let's talk about just 2 or 3 of the main distinctions between loans. First, we often distinguish between loans according to whom the bank is lending. Banks lend to businesses, including to other banks, which is often called commercial and industrial or C&I lending, or also called wholesale lending. Banks also lend to individuals, which is called retail lending. We've already covered the basic types and terms of loans in a previous lecture, so I won't go back over those details. But I will say that in addition to regular loans, banks also provide lines of credit to both businesses and individuals. A line of credit is pre-approval to take out a loan, up to a certain amount, that the borrower can use whenever they like. Borrowers like the flexibility, and the bank earns a monthly or annual fee just for holding the credit line open for the borrower. And when the borrower actually taps the line of credit by borrowing, the bank earns interest on the resulting loan. When we add up all the interest that the bank earns on the various loans that it makes, and add up all the interest on all the deposits that the bank takes, we can compare these numbers and get a very important measure of a bank's profitability called its net interest margin. Roughly speaking, a bank's net interest margin is the difference between two ratios. The first ratio is formed by taking the total amount of interest earned and dividing by the total amount of all the interest-earning assets the bank holds. This gives us the average interest rate the bank is earning on its loans. The second ratio is formed by taking the total amount of interest paid out by the bank and dividing this by the total amount of borrowing the bank does. This gives us a measure of the average interest rate a bank pays on its deposits. The difference between the two is called the net interest margin. The higher the net interest margin, the more money the bank earns each time it takes $1 of deposits and turns it into $1 of loans. The net interest margin on most banks is somewhere between 2 and 8%, usually closer to 3 or 4%. Notice what that means. For every dollar the bank takes in deposits, it's earning roughly 3 to 4 cents. And from that 3 to 4 cents, it has to pay most of the costs of running the bank, like paying the tellers and loan officers. And it has to turn a profit. So if the bank wants to be profitable, then it needs to take in a huge amount of dollars of deposits, right? If a bank has $100 million of deposits, now the net interest income is between $3 and $4 million. That would still be a fairly small bank. The really large ones have total deposits and total loans measured in tens of billions of dollars. Now we've learned about the lending that banks do, and we've seen that it can be profitable. We haven't learned what it is about banks that makes them especially successful lenders. Again, as I mentioned at the start of this lecture, banks are usually the first financial institution to appear in an economy, and in most countries, they dominate the financial system. That is, in many countries, the vast majority of lending is done by banks. This can't be a coincidence, so let's look into the reasons why banks have a natural advantage over just about any other kind of lender out there. Given what we've learned from previous lectures, I hope you're thinking that banks' advantage in lending has something to do with information. Banks are better at lending because they have more information and better information than other lenders do. And that information advantage comes from the deposit accounts they offer. When you open a deposit account with a bank, the bank keeps track of all the money going into and coming out of the account. That's their job, right? That record of all your transactions tells the bankers a lot about you. The bank learns about your income, about how much money you tend to have in the account at any given time, about whether you pay your bills on time, and lots of other details about your financial history. In other words, the bank learns about several of your 5 C's, like capacity, capital, and character, simply by keeping track of your deposit accounts. And since people tend not to change banks very frequently, banks accumulate a lot of information about you over time. They get similar information on many other depositors as well. So the bank accumulates a huge amount of high-quality information about the creditworthiness of all its depositors. It can use this information to make well-informed guesses about which depositors are good credit risks and which ones are not so good credit risks, using some of the same methods we learned about in the lecture on credit analysis. In other words, this information gives banks an advantage over other lenders when it comes to mitigating adverse selection and moral hazard problems in lending. On top of this, only the bank sees all this deposit information. It's just not available to the general public. If everyone could see this information, they could also use it to make good guesses about people's creditworthiness, and they could compete with the bank to make loans. But because this is private information, that is, only the bank has it, only the bank can take advantage of the information. As a result, the bank can make better, more profitable decisions about whom to lend to. This information advantage alone goes a long way towards explaining bank success. This also explains, by the way, why banks will generally only lend to people who have accounts with the bank. Banks need to be able to see your deposit activity so they can better evaluate your creditworthiness. Banks have another advantage over other lenders as well, and yet again, this advantage stems from the deposits that they take. If the bank makes a loan to you and for some reason you can't or won't pay it back, what can the bank do? Well, it can simply seize your deposits. Banks put a covenant, remember these restrictive covenants we learned about in a previous lecture, into every loan contract, in which you agree to give the bank the right to deduct money directly from your deposit accounts if you fall behind on your payments. This gives the bank a fast and easy way to recover at least some of the money you owe it in case you default. Notice that this gives the bank a huge advantage over other lenders if the borrower goes bankrupt. For example, suppose a borrower has taken out two different loans. One is from his bank, and the other is from a wealthy individual. If the borrower doesn't pay back either loan, then the bank can take money right out of the borrower's deposit accounts right away, while the wealthy individual will first have to go to court and sue the borrower to get the right to collect money from her. By the time the individual takes the borrower to court and then hires a collection agency, the bank has already collected what it can from the borrower's deposit accounts. There may not be anything left for the wealthy individual to collect from the borrower. This access to the borrower's deposit accounts gives the bank better protection against losses when a borrower defaults. It's another reason why banks require you to have a deposit account with them before they'll allow you to borrow from them. Now we have an explanation for why banks have played such a dominant role in the financial markets throughout history and continue to do so in most economies today. Banks are simply better at the business of lending than other institutions. First, they can make better quality loans than other potential lenders because they have better information about the potential borrowers. And second, even when a loan does go bad and the borrower can't pay, the bank has the better ability to recover at least some money from the borrower. Both of these advantages come from the fact that banks take deposits. But even though banks are very good at lending, this doesn't mean that there isn't any room for alternative ways to borrow and lend. In fact, one of the most significant developments in the financial markets over the past century has been the rise of these alternatives. We'll learn what these alternatives are and why they have only recently challenged the dominance of bank lending in the next lecture.